the banking sector has been doing well last couple of days. Kotak, Axis, SBI, IndusInd, the entire. But broader markets is where the focus is right now. The stocks are edging at all-time high on the aggregate level at the small cap index level. So we thought of getting you somebody who understands that space very well, manages a clutch of funds, the mid cap and the small cap too. We have got Ambit PMS's Aishvarya Dadheech, who is joining us right now. Emerging giants, the coffee can, and of course the mid cap portfolio is what he looks at very closely. Aishwarya, thank you so much for your time. Let's start by understanding your thoughts on aggregate small cap as a pocket. Increasingly, how does it show on the valuation metric versus the large caps? And also, increasingly, there is chatter coming in that parts of it have become frothy. What are your thoughts there?
Thank you, Ajay. Thank you first of all for inviting me to your show. Looking at the market, and especially the broader market, we have seen that the outperformance of the mid cap and small cap compared to the large cap has continued what we saw in calendar 2020. Even in this calendar, there has been a massive outperformance. And we possibly believe that this trend going to continue, even it has enough leg room for that to see the momentum. If you have to really connect the dots, when we look at the market participant in that particular space, talking specifically about mid caps and small cap, all the three participants, DII, FI, and even the retail, has increased their exposure to this particular segment. If you look at the last 5 quarters, the DI ownership into mid and small combined has moved from 0.5% to 2.8%. Right, whereas even FIs has increased it from 2.7% to almost 3.3%. Large part of increment happened on the small cap side, and the retail part, which is basically what is leading the market rally, has increased it from 3.1% to 3.9%. And we have always seen that if you look at the last 20 years of history, whenever the economic recovery has seen strong momentum, the broader market themes, mid cap, small cap, do meaningfully well. Right, it happened from 2004 to 2007-8, where we saw the massive outperformance of this particular segment. It also happened in 2017 when our GDP grew almost 8.3%. Standing right now, right, we believe that possibly over the next 2 to 3 years, once we come out of this COVID thing, economy is going to go give a lot of boost. There will be a normalization. We are seeing that possibly we will be doing double-digit growth on the economy for FY22 and possibly 7-8% further on FY23. All it, alongside lower interest rate, bode very, very well for the mid caps and the small cap as a sector. But Ajay, like one point you rightly mentioned, that is it kind of a froth which is building up? Is it the valuation being a concern? Yes, to some extent, if you really look at the valuation of Nifty 50 and we'll compare it to Nifty mid cap 100, Nifty mid cap and valuation has come in line with Nifty 50 as we speak. Small cap are still relatively cheaper compared to that, but we are missing out one very important point here. We have to look this into with alongside the growth expectations which we are building up. We believe we are entering into a very solid earning growth momentum, which will be visible for companies across mid caps and small caps companies alongside the large caps. So this earning growth is to an extent, justifying the moment that we have seen in the market. Very important point here that whatever moment of the market has happened is just not justified by the re-rating. Large part of it is to do with the earning growth. A lot of sector segments, have actually gained meaningfully from the COVID crisis. Those players with the strong balance sheets, with the strong brands, strong distribution, those good and clean companies, in the mid cap and small cap space are gaining a lot of market shares from the unorganized space. And their earning trajectory is looking very, very promising. And that justifies the kind of valuation that is visible in the market as we speak.
Right. Aishwarya, if you talk of the 3 portfolios which you look at, can you give us a sense on what kind of earnings trajectory do you see, after reworking the numbers of the latest earnings season and talking to managements, on a 1 to 3 year basis, what kind of earnings CAGR growth are you expecting for the 3 portfolios which you look at?
Sure. So we initially, when we started this year, before that COVID-2 happened, the expectations were pretty upbeat. But after taking into consideration of the COVID impact and its impact on the economy and this thing, we still believe that we are owning those kind of businesses which are gaining out of the whole crisis. Those businesses which are gaining of the formalization which is taking place in the economy, right? So in spite of that, we believe, over the next 2 years, this portfolio should see an earning growth of anywhere between 20%, 23% kind of a number, right? The emerging giant, which is a small cap portfolio, is going to see the highest growth on the earnings side, primarily also because of the base and the companies that they're constitute of are gaining, a lot of contribution from that side. We have allocations towards sectors which are doing phenomenally well. We have higher allocations to chemical as one of the sectors. Similarly, we have very decent exposure to home building, right from coffee can to good and clean, as well as the emerging giants. BFSI is another one which we believe which will witness a very strong earning momentum. So if you look at the portfolio construct earning growth, the earning will be more front loaded. We will see more of possibly 25 to 30% on a base case, earning momentum in this portfolio in FY22, giving a caveat that possibly the COVID-3 will not be as worst as COVID-2 has been. But in FY23, possibly we will see earning growth of 15 to 20%. So an average comes around 20 to 23% for this portfolio. And when you look at the valuations, in that perspective, most of these portfolios are trading between 1.1 to 1.3 time PEG ratios, if you exclude those BFSI numbers there, which gives an enough room, for, if not the re-rating candidate, but at least they can go and, take those earning growth as an element of making return for our investors. So we are pretty confident about the earning trajectory, and we believe just not for our portfolio, the earning trajectory look very solid from the overall market perspective.
Right. Aishwarya, how are you looking at the consumer discretionary space in the economy, consumer-facing businesses in the economy which were shut or got impacted because of the COVID second wave? Essentially, I'm trying to understand from you the businesses which were affected because of the second wave shutdown and lockdown, and the unlocked trade also loosely being called in the market. But businesses which suffered in the last 6 quarters, do you see mean reversion happening to some of these businesses? I don't want names from you, but the categories which may actually see a reversion as far as business rebound over the next few quarters?
So we believe it's very, very likely, all these contact intensive sectors which were bore the brunt of COVID, possibly will see normalization happening through. We've also seen RBI coming out and bringing them the liquidity required for them to come back on their thing. So especially sectors like, travel related stuff, tourism, luggage, airlines, restaurants, cinema, theaters and all. Possibly if we have already seen that there's a stabilization happening for COVID-2, we are seeing the number of cases going down. And as and when the vaccinations gain a lot of pace, we believe our government is now focusing very hard on getting people vaccinated. And then if you see this become a success story over the next 3 to 4 months, we strongly believe these contact intensive sectors which are being impacted most, will see a big mean reversion. But the one beautiful thing which will play out in this sector itself is that there's a huge amount of consolidation which has happened. A lot of weaker players in the form, those players which had too much of leverage on them, or they had limited scale to raise money, or limited brand or distributions, have actually vanished from the whole space. And the leaders, the couple of leaders in each and every segment, will possibly or meaningfully gain out of the whole thesis. So we believe it's going to be a beautiful trade to invest into those sectors which are strong in this particular theme, and they who will benefit once the economy gradually opens up over the next couple of quarters. This is one area which we believe is very, very promising from that perspective.
One last word. Going forward, I want to understand from you what kind of commentary did you gather from when you were talking to the universe of companies you have in your portfolios on the quality of earnings in the medium term. Do you see inflation hitting some of them going forward in the next 1 or 2 quarters? Because inflation is the key issue Can you give some feedback about the kind of efficiencies companies are trying to drive in their business models? Basically, a kind of a flavor of the chats which you've had with some of the managements lately.
Sure. So one thing I want to bring to everybody's attention is, when we are interacting with a lot of these mid-cap, small-cap companies, even before COVID-2 happened, there was an uncanny sort of optimism on the demand side. They were talking about demand trajectory, which possibly they have not witnessed in the last 5-7 years. And then they were preparing themselves to bring up the capex and try to see whether they can meet those kind of demand over the next 2-3 years. And then we entered into COVID, and then obviously we also see that inflation coming through the roof, at least commodity led globally. When we're interacting with the management now, right, they have become at least a bit somber because of uncertainty around. But at least on the inflation side, what we believe is there's two parts to it. One, obviously, is that if you look at globally, most of those countries are showing growth in GDPs. Talk about US or talk about European countries, the kind of growth they have witnessed just 2 or 3 times in the last 100 odd years. So there's a huge demand pull which is there. And at the same time, there is a supply shock. If you look at the capacity utilization of the industrial countries has not come back to where it was, right? So there's both double whammy impact, which is hitting inflation on that side. And again, the lowest interest rate is pacing up the commodity prices. So inflation is a worry, but what we believe is that, it's more to be a transient, at least on the global side. Once the supply side things normalize, even the growth side normalize, we will see inflation tapering down. Coming to India and our feedback on the companies, most of them have been able to pass on the price hike, given the ability to consumption has also been hit, but most of the companies that we are interacting has been able to see that, passing on the price, inflation is there. We believe in India, at least the inflation will start see the base effect for the next 4-5 months, unless and until if the crude completely goes out of havoc or reaches $85-$90 or something more than that. We believe inflation is quite manageable. And last but not the least, people in equity always love inflation because inflation, healthy inflation is always conducive for higher earning growth, which we believe will possibly, if we stay there around 4 to 5% kind of a number, it will remain very, very comfortable from equity market perspective.
All right, Aishwarya, we'll let you go on that one. Thanks so much for joining us with your thoughts on the show today.
Thank you.
Thank you. Aishvarya Dadheech of Ambit PMS talking about his portfolio approach. Let's take a short break for the spotlight on the power stocks, how to play the power space. We'll get Rupesh Sankhya of Elara on the other side.